Great. Thank you, and good morning, and thank you so much for that very warm introduction. It makes me feel very proud to have done so much work. I'm delighted to be here today to have the opportunity to speak to you all, and to be invited to address this event, which really is half a world away from home, about insurance and consumers is something that really would have been very hard to imagine when I first started campaigning on consumer issues 20 years ago. Probably as difficult for you to imagine losing at Twickenham the other weekend. So I've been asked to share some of my personal reflections of my time as a consumer advocate and now as a voice of industry, and as part of that to highlight some of the changes that have been driven by UK and European regulation and also emerging from the market itself. When I was preparing for this speech and I was thinking back over the time from when I started in consumer advocacy in the early 1990s, it really struck me the amount of profound change that's happened in many consumer markets, including insurance, in the last 20 years. Just take technology, particularly the explosion of mobile and data services. When I organised events and conferences back in about 92, 93, none, I've got to say, as impressive as this gathering. I sent everyone an invitation letter in the post. There was no PDFs, there was definitely no email. Our mobile phones were pretty limited to the basics, which was making telephone calls, and social media was just another name for Hello Magazine. Financial services in the UK were also in a very different place. Life insurance was sold through advisors driven by commission, not fees, and that's a legacy in the UK that we're still dealing with today through mis-selling scandals and ongoing charges. In general insurance, price comparison websites weren't the powerhouse of distribution that they are today. Almost all of our major comparison sites have launched since the turn of the millennia, which gives you some idea about the scale of change just in the last decade. Brokers and other third parties, such as banks, were the only way that most of us bought our everyday general insurance products. And in fact, my experience of when I first bought insurance is a good example of how things have changed. I was going to university, it was 1990. I visited a high street broker. It's rather quaint now in the UK to think of a high street broker. And I had to wait to be seen. Went into a waiting room and I waited. And I waited. And imagine an 18 or 19-year-old today waiting for anything, never mind the pleasure of buying insurance. In fact, today's 20-year-olds in my team, I sort of, talk about brokers when they first start the ABI, they just look at me blankly. You mention the term broker and they just sort of think, well, what is she talking about? They know insurance as something that you have to buy, and you have to buy it online. What about other changes? Well, 20 years ago, driverless cars were only in sci-fi films. They were definitely not on the streets of Bristol, as we see them today, and the data revolution was simply unimaginable. The sheer scale of change in the amount and type of data generated really is unbelievable if it weren't for the fact that we know it's happening. And this is a fact that I love. The amount of data created between the dawn of history to 2003 is now created every single day. Just think about that for a minute. All that information about people, their likes and dislikes, habits, friends, family, purchases, behaviour, all captured, all there to be analysed and assessed, used and potentially misused. It's an incredible fact reflecting an incredible time of change. And throughout this time of change, I've been working in financial services, seeing the changes from both the consumer and now the industry perspective. My job has been to create and navigate changes to laws, regulation, to persuade industry to change what it does, all in response to the changing economic, social and technological times that we live through. Now, you'll hear an awful lot of perspectives today, so I'm just going to highlight my three main messages. The first is what we share as consumer and industry advocates. The second is, in the UK, what we face as regulators, both domestically and globally, challenge us across all parts of our insurance sector. And the third message is about what we can do, being proactive in tackling challenges both today and in the future. So first, our shared agenda. Well, having led campaigning for the biggest consumer group in the UK and driven powerful campaigns that really did change quite a lot in financial services, I know I bring a unique view. But having seen both sides, I believe consumer advocates and industry share many of the same perspectives. I trust we agree that insurance is an essential product, that right now insurance is providing a safety net protecting families, property, businesses and livelihood, that it gives stability to developed societies and underpins economic success by spreading risk. I hope we'd all agree that we want an effective market in insurance, a market where consumers get the products they need and understand at a good price, and where insurers are competing effectively and running successful businesses. And I'd also believe that we agree that transparency, clarity of terms, great customer service, and fixing problems when they go wrong is pretty fundamental to ensuring that effective insurance market. So if consumer and industry advocates agree on these principles, why is there still so much that can go wrong? And why can it be so hard to create a market that works as well as it should do? Well, in my experience, consumer groups and industry just find different ways of working towards that shared goal. Consumer advocates agitate for change, launch campaigns, name and shame, are noisy in the press. Industry innovates with products and offers, competes on price, features and customer service. I know how frustrating it can be to find your industry at the sharp end of a consumer campaign, but I also know how great it can be to be leading that campaign, to stop consumer detriment and create better outcomes. I also know how effective it is to find a case study, just one, showing how badly things can go wrong. But I also know, sadly, that in the UK I can find hundreds of them like that. Tales of confusion, bad service, terms and contracts that didn't deliver, and customer service that lets people down. Tales of insurance not delivering the promise made when the customer bought the product, to promise to protect, to put things right and be at your side. It can be tempting but misguided to dismiss these campaigns, because I think we'd all recognise that they reflect something that has gone wrong in the most basic way, that consumer rights have been left behind. And sometimes when I talk about consumer rights back in the UK, I sort of get a slight eye rolling. But actually, their consumer rights have not been dreamt up by the consumer lobby of modern day. It's the US President John F. Kennedy in 1962 who was the first to draw together and advocate the essence of consumer principles and consumer rights that we still use today. He understood the most basic right for the consumer, to choose the right product at a competitive price. But he also recognised that markets are complex and that consumer rights weren't limited to choice and price alone. Consumers have a right to safety, to be informed, to be heard. He said, obviously, that by definition, consumers include us all, and he established the consumer agenda that we're still debating today. And it's these rights, and others such as the right to transparent information, to redress when something goes wrong, and to effective representation that underpins any successful market. And looking at your own fair insurance code, I can see so many of the issues you seek to tackle in that code reflecting these basic consumer principles. Of course, healthy competition and active switching are just two indicators of how well a market is working for its customers. And a key innovation in the UK, which you'll all be aware of, and one that has undoubtedly boosted the ability of consumers to switch, is the development and ascendancy of the price comparison website. It is a revolutionary distribution channel, and it's really good news for consumers. And it's innovative, and it's had a far-reaching impact. For consumers, the new technology makes it easy to see the options, get a good price, and instantly buy. But it's good for providers too. Price comparison websites open the market to new entrants by lowering the cost of access. And it's not just new disruptors who benefit from this access, but also established providers who create new brands and tailor their offers in different ways. There are many direct providers in the UK who also sell via price comparison sites as well, just with different brand names and different offerings. But of course, there is a flip side to this relentless focus on price. Consumers choosing on price before everything else makes you wonder. Does the customer always consider the right cover for them? And are providers simply focusing on chasing market volume to demonstrate shareholder value? And what suffers when prices are low? Customer service, cover, terms? Does this customer simply get what they pay for? And do they understand that? There is a regrettably perfect example of how headline price has contributed to damaging behaviour in the UK, and that's the market and payment protection insurance. It has now resulted in the biggest financial services mis-selling scandal in UK history. Cheap personal loans made such little margin that banks came to rely on the sale of PPI to boost their profits. And PPI policies were sold, not bought, in their millions. Salespeople at one firm received 6 times the bonus for selling a personal loan with PPI than one without. Commission-driven sales ended up driving the market over the cliff. We now have 13 million consumer complaints and a compensation bill that today stands at £26 billion. Yes, you did actually hear me right. It was £26 billion given back to consumers because of mis-sold insurance products. And mis-selling scandals highlight the challenge of achieving a well-functioning market because we know that in the most complex markets, where consumers choose products infrequently, where people lack confidence in basic financial skills, and where the cost can be significant and the expertise is with the provider, that sometimes relying on the power of market forces to protect consumer rights isn't enough. And it's this dynamic, combined with the global financial crisis of 2008, that led the UK government to move to a Twin Peaks regulatory model. So as a sector, what do we face in terms of regulation? The crash really did change everything for insurers in the UK. Whilst much of the public scrutiny quite rightly centred on banking, the revolution in the UK regulatory system is having profound impacts on our sector too. We now have a very active conduct regulator, the Financial Conduct Authority, and one that now also has a statutory remit to promote effective competition in the markets it regulates, including insurance. So where once general insurance was a second-order priority for intervention, the past 3 years has seen a constant flow of market studies and thematic reviews, investigating and scrutinising all parts of the general insurance sector. And I'm naming just a few here, believe me, there are plenty more. Motor legal expenses insurance, claims handling, add-on products, consumer communications, premium financing, value measures. That sounds innocuous, but it means how do you actually help customers understand whether your product offers value to them or not? All this requires input and engagement across months, often years, from the ABI, our members, consumer groups and stakeholders, all with the target of an effective market to drive competition and protect consumers. The FCA approach to investigations is broad, exploring information asymmetries, consumer behaviour and firms' competitive strategies, and how their combined impact works on market and consumer outcomes. A new direction for the FCA in recent years has been their commitment to use insights from behavioural economics, together with more traditional analysis of competition and market failures. And it helps them assess problems in financial markets and choose the most appropriate remedies. I think it's a really good additional insight for the regulator to use this, because the lessons from behavioural economics reinforce what we all intuitively know. The lesson is that consumers don't act in ways that the theory and economic textbooks. Of course they don't. For insurance particularly, where decisions requiring assessing risk and uncertainty, people are generally bad, if not terrible, at considering risk and looking to the long term. And of course, consumers really should shop around and switch. We all know that, to get the best deal and to drive competition. And in the ABI's latest research, we know the picture for UK insurance is better than in other sectors. Consumers are much more likely to shop around for general insurance products than for a new bank account, mortgage, phone contract, or energy supplier. But many people don't shop around or switch, and the way that the market works for these less active consumers is under greater scrutiny than ever before. Why is it that some customers who've stayed with their current home or motor insurer, who you would argue are being loyal, pay so much more than new customers? Why don't insurers tell their customers what they paid last year on their renewal notice? What about older or more vulnerable customers, or those with a lower tendency to shop online? How do we ensure their consumer interests are protected? All of these questions are being asked right now by consumers themselves, journalists, consumer advocates, regulators and politicians. And the ABI has been grappling with these challenges for some time, recognising the significant reputational risks from them posed to our industry. There is, of course, a first-mover disadvantage to firms acting alone. But through an effective trade association, the market can work together within the constraints of competition law to improve consumer outcomes. And the ABI has called on our regulator to introduce greater transparency of renewal prices. And just last week, at a conference just like this, we announced our intention to introduce a new code for vulnerable customers. But for regulation, our sector faces two ways: inside the UK to the FCA and the PRA, and outwards to Europe, where our membership of the European Union brings with it new layers of regulatory inquiry. Members of the European Parliament in Brussels debate, in great detail, customer disclosure documents. They actually design them. And regulators in Frankfurt steer Solvency II and the new capital requirements for European insurers towards implementation at the end of this year. But perhaps the single most significant intervention of all in the insurer-customer relationship has come from the European Court of Justice ruling that insurers could no longer use gender in their pricing or underwriting. So the risks I pose as a woman, my different life expectancy, my health, my better driving, it's all to be ignored when insurers price the risk and offer a product. As you'd expect, this case, which was brought by a Belgian consumer group, Testa Shah, has made a very significant impact on our market and how products are priced for our customers. But there hasn't been the level of disruption that many feared when the change became law in 2012. Women have paid some more for car insurance, but they've also received some more for their annuities. In the end, the competitive market has managed the issue well, just as it should do. I believe the greater impact has come from the realisation that policymakers and campaigners will go to great lengths to intervene in our market, and that this intervention derives from a view that what insurance is and what insurance does is just too important to leave solely to the market. That competition may not always deliver fairness and access or ensure consumer rights are protected. The question for us then is, where else will this intervention be targeted and what will prompt it? And what can we do about this intervention and the challenges we face? Our European policymakers care deeply about whether it is fair to use age, disability, or health as risk factors in insurance. And this could well be our next battleground, a battleground where data is the ammunition on both sides. So if we turn back to data, the volume of information and data being collected today, what does it actually mean for the customer? Do consumers understand what companies or organisations hold on them, or how they use that information? Do they understand the permissions they give when they tick those little boxes online? Do they think about what they share on Facebook or Twitter, how that could be stored or shared or analysed? And faced with this data barrage, how well are insurers investing in their data and analytics functions? Will insurers soon understand some risks so well that for some customers, insurance becomes unaffordable and inaccessible? Will the data revolution create a new class of uninsurables? In the UK, we're tackling a very real example of just this and have already formulated one solution for flood insurance. Summer 2007 saw some of the worst floods in recent memory hit the UK. It was the wettest summer on record, with 56,000 homes and businesses flooded, water was waist-high in people's houses, and power stations were at risk, and £3 billion was paid in claims. And for our industry, at the very moment we were tested, when the insurance promise needed to prove its worth, too often we failed to meet customers' expectations, with a weak emergency response, lack of alternative accommodation, poor communications and poor service. When customers needed their insurer to be there, we didn't always rise to the challenge, and there was significant reputation damage to the whole of the sector. But the scale of the flooding not only shook insurers, but for customers, the reality hit home when it came to renewal. For some people, accessing affordable flood insurance became harder and harder. We estimated that between 300 and 500,000 homeowners would struggle to buy affordably priced flood insurance if the market would offer them cover at all. And that's a potentially systemic issue, given any mortgage provided requires home insurance to be in place to protect their loan. The industry looked long and hard at this problem, a problem that climate change and property development were only making worse. And it was the industry that proposed a radical solution to overcome the market failure, a solution so that people could continue to access affordable flood insurance even if their home was at a high risk of flooding. The UK solution is Flood Re. And when Flood Re becomes operational in April next year, insurers have the option to pass the flood risk element of home insurance to Flood Re at a premium that is fixed. And all home insurance customers will pay a levy into Flood Re to support the system. It's a neat solution, but one where those at lower risk do cross-subsidise those at higher risk. And so fast forward to the winter of 2013-14, right in the middle of the negotiations with government about Flood Re. More homes faced the misery of flooding, but this time our sector delivered a different response. Emergency teams were on the ground immediately and stayed there. Chief executives were acutely aware of the need to deliver the insurance promise to their customers, who faced the upset and upheaval flooding brings as they lost their homes for months on end. Where local authorities and utility companies very publicly often fail to respond with urgency, our members' actions delivered when it was needed and boosted the reputation of the sector. And this delivery, when it mattered the most, was a key factor in maintaining support for the concept of Flood Re across the political spectrum. And we needed political consensus because capping costs and creating a levy demanded new legislation. And an industry that delivered for its customers in 2013 had a much stronger negotiating position than that one back in 2007. For me, the innovation that is Flood Re highlights that the sector has to be alert to how its pricing, practices and products may place the industry in some uncomfortable positions, prompting searching questions from policymakers and regulators about whether it is delivering for the public and in the public interest. And Flood Re represents one of the most significant interventions in how an insurance market works in living memory, and in fact in any market, but it is unlikely to be the last. Flood Re also proves our industry is more than able to lead innovation in response to the changing world. But how well placed is our sector to respond to innovation from elsewhere? The biggest taxi firm in the world owns no cars, and the biggest accommodation provider in the world owns no hotels. Consumers have taken to these new disruptors with ease and at speed, happy to challenge the incumbents and vested interests. And taking Uber and Airbnb as just two examples, it also challenges us to think about insurance in different ways. The sharing economy means we'll own fewer things. What does it mean for insurers? Do we still insure the item, or do we insure the person?
Any change in my behaviour or circumstances is currently only reflected in my insurance premium at the time of renewal, usually once a year. Maybe insurers could use big data to price my insurance more accurately and in real time. Maybe I'd change my behaviour sooner if I knew it would keep my premiums down. And telematics-based motor insurance has shown how this can happen in practice. Whatever the innovation, however it changes the dynamics or the players in the market, underpinning its success are the consumer rights I talked about at the very start. And whatever the challenge insurers face in the future, taking our customers with us and being transparent and trustworthy are essential requirements, whatever the product. So I was asked to share some of the lessons I'd learned from my time as a consumer champion and now as an advocate for the sector. And the lessons for me are that consumer rights are fundamental and underpin effective markets. That regulation has a very important role to play in creating more effective markets and ensuring competition really works. And for our industry, innovation is probably one of the most challenging but necessary responses to regulation and consumer rights, particularly as we live through the data revolution. So I've thought really hard about how I can capture all of this in a simple sentence and in a way that sums up the complexities and challenges we've considered today. And I find myself returning to something I learnt when I first joined Which. What's good for consumers is good for good business. Thank you. Okay, thanks.